Good morning. Today is November 13th, 2024. We're going to spend a little bit of time today doing our mid-month discussion of the S&P 500 valuation analysis. So let's jump right into it. First, a little bit of housekeeping. Remember that the information here is opinion only, and this is certainly not financial advice. Please consult a financial professional should you have any questions that are specific to your situation. I want to spend a couple of minutes with some more housekeeping going over a little bit of an overview and some of the objectives of this analysis. First of all, this is a high-level top-down discussion. We're going to look at common S&P 500 ratios and relationships. This analysis is rooted in objective and quantitative measurements. Certainly, I understand that there's a lot of emotions, opinions, other subjective measures out there. You're going to get lots of different perspectives depending on who you listen to. We're going to try to filter out a lot of that noise and focus solely on some numbers today. And all these numbers that we're looking at, this is based on publicly available information. And ultimately, the objective of this analysis and discussion is really to determine the relative attractiveness of investing in the S&P 500, and in particular, looking at the risk-reward balance that the index offers and seeing if it's compelling or that if there are some downside risks. Again, today is the mid-month, middle of November. The goal for this work is to provide both a mid-month and a end-of-month update and discussion as we move forward. So let's jump right into it, looking at the S&P 500, and I've plotted a chart here on a logarithmic scale so you can see it a little better. Obviously, no surprises here. The S&P 500, looking back over 60-plus years, has done remarkably well, even in periods where there is some volatility. You can see that the long-term trend is certainly upward. As Warren Buffett says, investing in America is a very, very good bet, and this chart helps to show that. Let's move now looking at the bond market, U.S. Treasuries, and the yield curve. So a couple things to note here. Number one, when you look at, and this is from the Wall Street Journal, when you look at the environment today in light blue versus a year ago, which is in black, you can see the yield curve has flattened considerably. We've had a couple of rate cuts here by the Federal Reserve over the past several months, which has taken the overnight rate down, I believe, 75 basis points. If you look at the long bond, whether your flavor is the 10-year or the 30-year, basically either side of 4.5%. So, and that's going to be important as we look ahead into this analysis and the impact that it plays on the value of the S&P 500. So digging in a little bit more, let's look at the price earnings history, some common price earnings ratios of the S&P 500. I've plotted through here. Two of them are just nominal PE ratios. One is based on operating earnings. One is based on reported earnings. And then I've actually put the CAPE, or the cyclically adjusted price to earnings ratio that Mr. Schiller provides and updates. And you can see a couple things here. Number one, obviously very volatile. And the second thing is, if we look at the CAPE in particular is pretty high right now. We're going to talk about this a little bit later, but approaching 40 on the CAPE, which is not the highest of all time, which was achieved back in the late 90s, but getting up there. And then if you look at the nominal PE ratios, we're somewhere in the mid to upper 20s, approaching 30. One note I'll make about price to earnings ratios, excluding the CAPE, but if you're just talking about the nominal price to earnings ratios of the S&P 500, I think it's very difficult to draw the typical conclusions that people will draw about this without looking in the context of bond yields, particularly the long bond. So really what I mean is, if somebody says a PE ratio of 15 or 20 is normal based on history, that completely depends on where the long bond is. A PE ratio when the long bond is 3% versus a PE ratio when the long bond is 6% are two very different things. And it's important to keep in mind as we move forward with this discussion. We'll talk some more about that. Let's look about a little bit about the dividend history of the S&P 500. Essentially, this is showing how much you're going to pay for $1 of dividends. And a couple things I'll point out here. Number one, I think just the structural environment of dividends has changed as we look back in history to 1960. I don't think companies today tend to pay out as much in dividends, versus other forms of returning value to shareholders as they did back in the day. But even so, you can see that where we are today is certainly near the high point. In other words, you're not getting a lot for your money in terms of of a dollar of dividends based on the price of the S&P. So just something to keep in mind here. Let's move forward and look at another way to look at price to earnings ratios. This time I want to look at the PE ratio of the S&P 500, which we looked at before. You can see it in blue there, right around 30. But I want to compare that to the, what I've calculated here is the PE ratio of the long bond or the 30-year treasury bond. And, the way that I get to the PE ratio of a treasury bond is simply taking the inverse of the yield on a bond, right? And so you can see what has happened over time here. If you look back over the past, really decade plus since the financial crisis, we have had a lot of pressure on the long bond. Yields have gone very, very low. The prices of bonds have been extraordinarily high. We've had intervention from the Fed. We've had long bond yields that have gone down between 1% and 2%, which is just unbelievable. And when that happens, you can see the corresponding PE ratio spikes as it did. As we've moved forward here, especially recently over the past year, 12 months or so, you can see we have finally seen an inflection point where the PE ratio of the S&P 500 has now moved above the PE ratio of the 30-year treasury, implying that stocks are pretty expensive relative to bonds. And this is important as we'll look to calculate the equity risk premium in a minute. But this is an important chart to lead up. Really, the environment that we have seen over the past, really since the financial crisis, so 10 to 15 years of stocks being cheaper to bonds, relatively speaking, has changed. And looking today, bonds versus stocks is not the same as the environment we just came out of. So what does that mean? Well, the equity risk premium is a really important metric, I think, probably one of the most important as we do this analysis. And really all we're looking at, we're taking the difference between the earnings yield of the S&P 500 and the yield of what I do is the 30-year bond. You can take the 10-year or the 30-year. They really lead to the same conclusion. But let me explain this chart real quickly here. As you look at the top above the x-axis, that would indicate we're in an environment that is more attractive for investing in stocks. As you go below the axis, that's an environment that is less attractive for investing in stocks. You can see, coming out of a period here between, again, the financial crisis and even for the last 10 plus years, we've been in an environment that's been pretty favorable for investing in stocks. And this is primarily due to the very low yields that we've seen on the long bond. Again, we've seen yields pretty consistently below 3%, sometimes substantially lower than that. And that has provided an unbelievable tailwind for the S&P 500 to perform very well. That has started to change a little bit for two reasons. Number one, the S&P 500 is quite a bit higher because of that tailwind today as it approaches 6,000. And number two, the yield on the long bond has gone up considerably now as it sits, either side of 4.5%. And when you look at this on the equity risk premium, we are seeing now that moving considerably lower. It is not the lowest that it's been, certainly. Back in the early 90s, even in the late 90s when we had the tech bubble, certainly the equity risk premium was eye-opening there. But it is important to note that we are moving into a certainly less favorable environment, and this will provide more headwinds for the S&P 500 than it has seen over the past 10 plus years. So moving on, a couple more metrics I want to look at. This is the Buffett indicator showing the S&P 500 against the GDP for the U.S., basically the total value of all goods and services. This is a really important metric. You can see back over time, historically where this ratio has landed. Well, today we have eclipsed 0.2 on this ratio, the highest it's ever been. Typically when we have these spikes, back in 2020, back in the late 90s with the tech bubble, they don't tend to last, and they are followed by periods of underperformance. Looking at the S&P 500 to book value, I've only got history here that goes back to 1999, so not quite as much. But again, if you look at this, we are in uncharted territory at a very high level, and this tells us that, again, probably a range that will be difficult for the S&P 500 to sustain, as it typically does not like to go above 5. We'll see how it does going forward, but certainly this would indicate that there will be some headwinds for the S&P 500. So finally, let's look at what this means on a fair value calculation. And I want to point out something important in terms of methodology. I do not apply just a blanket PE ratio to calculate fair value. I don't just say, look, the normal S&P 500 PE ratio is 15, so I'm going to apply that to the estimated earnings and get an estimate. That's not the way it works, and I explained earlier, the PE ratio is largely meaningless unless you look at it in the context of bond yields. And so what I do is I take that PE ratio of the long bond that I indicated earlier, and that's really the metric that I use to calculate what is fair value. And if you look today, where the PE ratio of the long bond is, we're somewhere in the mid to low 20s, I think around 23. So this is really, where I land when trying to determine fair value. And you can see, again, if you look back over the past, 10 plus years since the financial crisis, we've been in an environment where the S&P fundamentally has been undervalued. And again, this is because of the very low bond yields. This creates an incredible tailwind for the S&P 500. In fact, when you see long bond yields get, around 2%, even lower, anywhere between 2 and 3%, it's really the sky's the limit in terms of stocks, in terms of what they can do. The fact that the long bond has moved from, those levels up now, 4.5, approaching 5%, this matters. This provides significant headwinds to the S&P 500, and you can see that over the past 6 to 12 months or so, where we've seen an inflection point. The S&P 500 has raced above what I would consider fair value, now sitting around 6,000, fair value closer to the mid 4,000s, and this will be important, as we move forward. So let's wrap it up today. I want to just give you a quick overview of what we've talked about. Again, in the top right here, you'll see a legend indicating, we look sort of at a red, yellow, green environment. If the indicator is green, I consider the investing environment to be compelling. If it's yellow, the risk reward is neutral. And if it's red, we seem to be unbalanced in terms of risk reward, and I would consider that downside risks. So if you look on the bottom at all the metrics we just talked about, the equity risk premium, the S&P 500 to GDP, the S&P 500 to the dividend ratio, S&P 500 to book value, the CAPE, and the fair value estimate. 5 of those 7 metrics I would consider red. I would consider it unbalanced with disproportionate downside risks. The 2 that I would consider yellow, again, the nominal S&P 500 PE ratio, which I already discussed, really is somewhat, I don't want to say meaningless, but you need to look at it in the context of long bond yields. And also the equity risk premium, again, not as bad as we've seen it in the past, but certainly not a favorable environment, and getting worse as the market continues to increase and bond yields continue to rise. So again, 5 of the 7 I would say are flashing red. This is not an environment that is compelling, and it really appears unbalanced overall with increasing downside risks. I would point out that a modest rise in long bond yields would seem to pose the greatest risk to me, to this market. If we see yields rise perhaps to 5% or even more, I think the market would be under substantial pressure. So again, final point, current value of the S&P 500, depending on when you watch this video, is right around 6,000. I think fair value, 4,400, call it mid 4,000s, I think is somewhat fair. So we are somewhat in the ballpark of 35 to 36% overvalued on the S&P 500. So pretty significant. So again, my opinion only, I think it's in an environment worth watching to see what happens. We'll see how the bond yields do. We'll see how earnings estimates come in. But again, we'll do this twice a month, middle of the month and end of the month. I appreciate everyone watching and hope this was useful. If you liked the video, give it a thumbs up. And thanks for watching.